Okay, let's talk about export and venture funding in this module. And as always, I'll do an introduction. And if you have questions, please join my quarterly Q&A. It's open to everyone who has taken my course or bought a product from me in the previous quarter. Now, here are some points to note if you decide you want to invest in export. Your role is that of an investor, not an exporter. So an investor facilitates or finances an export project. So you don't need to be an exporter to be an investor in export. So it's an important distinction. You can finance a venture by an existing exporter without necessarily being an exporter yourself. So your role is finance, not exporting. Now, the returns for export are in foreign exchange. So as an investor, if you're financing an export opportunity, your returns are always in Forex and not in Naira. So you can insist on this when you're signing an agreement with an exporter. It requires an understanding of the export process. So you'll find that there are various levels that you can finance. You can finance transportation, you can finance supplies, you can finance documentation, you can finance the actual shipping process itself. So you need to understand the process. So even though you're not an exporter, you need to have done a course or have done a preliminary introduction to export so that you can understand the process, understand the value chain, and you know where your financing or where your money is going to. Now, there's a checklist if you want to invest in export. There's some things you should look out for. There's some things you should note and that you should ask the exporter. So every exporter must be registered with the Nigerian Export Promotion Council. So one of the first red flags, if someone approaches you or a cooperative approaches you to fund an export venture, if the company does not have an NEPC certificate, then they're not registered statutorily as an export entity in Nigeria. So it's something that you need to ask for and cite. Number two, do they have an export plan? Is there a plan in place for the export that shows we've identified the supplier, we've identified the shipper, we've identified those that are going to issue our phytosanitary certificates, we've identified how it's going to be shipped. There must be a plan, and then they must have run the numbers. So they're looking at every point in the value chain, how much is it going to cost and what is going to be the profit at the end of the day, and the timelines. So if they don't have an export plan, it's similar to when you're going to provide venture funding to a business. You typically ask for the business plan. So in the same way, when you're going to provide financing to an export venture, you need to see the export plan. Find out if they have credible suppliers. So if it's an agricultural product, for example, do they have credible suppliers such that they're not stuck at any point in the value chain? Do they have a valid contract from the buyer with specifications? So a lot of times the potential buyer would have specified exactly how they want the product. So by the time you look at the supplier and you look at the specifications, if the supplier cannot provide the product based on the buyer's specifications, then you already know that something is wrong. And what you also do is that at the point of shipping or packaging before shipping, you should also verify that what is on the contract is actually what you're seeing, or what has been packaged for shipping, or else the buyer is going to reject that product at the point of entry, and you're really going to lose all your money. Is there a quality certificate that is required? So if it's a food or plant product, does it need to go through certain inspections, certain verifications, so that there's a phytosanitary certificate that is issued? Does the exporter have the required documentation by the specified by the Nigerian government or customs, such as the NXP? Is there insurance? Does he have a bill of lading? So those are things that you need to check to be sure that every box has been ticked along the export process. Is the exporter properly branded? A lot of times potential buyers will go to the website of the export company to check them out. Do they look solid? Do they have contact information, contact address? So also do that as part of your due diligence. Be sure the exporter is properly on ground, has the necessary structures and the necessary brand outlook for the venture. And then explore the value chain. Like I've said, there are different roles you can play in the export process. You can even help get a supplier. So in lieu of direct funding, can you link up the exporter to a credible and consistent supplier? In lieu of export funding, can you link the exporter to a buyer? So these are different things different roles that you can play in the value chain. If you travel regularly, you can be the one attending expos, all over the world, so you become the representative of the exporter, and you simply just make a cut, a commission for every buyer or every deal that you bring to the exporter. You just get a cut. So there are different places that you can explore along the export value chain. So how to begin? Join an export cooperative. That's the easiest way. If you go on nepc.gov.ng, their website, or visit their office, there are a lot of events that they hold that bring different exporters together. The Nigerian American Chamber of Commerce also has a lot of export-related events. You can also attend expositions. So agriculture expos, fashion, textiles expos. These are places where you meet exporters. These are places where you meet export cooperatives. They usually have booths at these expos. Embassy events as well attract exporters. So once you join an export cooperative, what an export cooperative does is that it puts together people with different strengths. So in an export cooperative, you can have the finance guys, you can have the marketing guys, you can have the guys that go and look for supplies, you can have the guys that manage shipping and packaging. So what an export cooperative does is it reduces your risk. So because you're then exporting with people with different strengths, it reduces the overall risk of that venture. Now, for venture funding, here's a checklist for you. Invest in what you understand. A lot of times I find that when people review venture funding opportunities, whether it's an opportunity that comes from Future Africa Collective, an opportunity that comes from VC4A, these are all platforms that bring deals your way. A lot of times you may not understand the business, and instead of reading the deal sheet, going to the deal folder and really understanding what the business is, attending the Q&A with the founders, a lot of times people outsource responsibility and then they come crying when the deal goes bad. If you don't understand what you're investing in, don't invest. So you really need to read the documentation and understand the business model. Read the pitch deck, read the business plan, read the audited accounts, understand the business model before you invest. So please only invest in what you understand. And if you don't know how to read financial models, why don't you get a friend who can interpret some of the financials for you? So if, for example, part of the deal folder is some forecast sheet or some financial model sheet, and you really don't understand, either go online to learn how to interpret it, or ask your financial advisor or your accountant to help interpret it for you, so that you really know what you're investing in. Ensure the founders and managers are credible and competent. Investing in venture funding is 50-50. No matter how brilliant the idea is, the founders and the managers are the determining factor for success. And because you're not the one managing it, you're not in the business day to day, if the founders and managers are cheats, if they're thieves, if they're incompetent, it's going to affect the quality of your investment. So ensure the founders, they have some track record, even if this is the first business they're ever founding. How was their performance at school? How was their performance at the last place they worked? What other ideas have they created? So find out whether they're credible or competent. Examine the business model and the funding cycle. At which point will there be a break even? It can't be a perpetual business that does not turn a profit. So when you're looking through the numbers, find out in how many years are they going to break even. As an investor, every year you are entitled to seeing the audited accounts of the company, so you can track and go back to the funding model to say, based on the initial business plan you guys did, this is what you had projected as performance, but your audited accounts don't match the performance you had promised. You're allowed to ask questions as long as you're an equity investor in a business. read their financial and bank statements. So before you make a decision, check their financials. Is there anything that doesn't make sense to you? Read the business plan, do a background check on the promoters, like I had mentioned, find out what they've done before, or if this is the first business, what kind of career have they had, did they do well in school, things like that. Assess environmental and political factors. So if it's a regulated industry or a heavily politicized industry, take those things into consideration before you make an investment decision. Now, moving on along the checklist, you need to be sure what your role is. Are you an angel investor or not? So if your only role is to bring money, there's a certain value you'll get. But if you're supposed to bring in your networks, your ideas, your strategy skills, your contacts, then you can negotiate for higher value. So define your role and make sure you get commensurate value. And then quantify the value of your contributions, which is linked to number 8. Once you define your role, quantify the value of what you're bringing to the table. So yes, you're trying to protect your investment by giving up your networks or becoming a brand ambassador for the business. But if you're doing over and beyond what an angel investor would do, then you should quantify that value and be well compensated in terms of greater equity or greater valuation. And then document everything and develop ironclad contracts. Nowadays, a lot of startups use a simple safe agreement, which was developed by Y Combinator. So there's usually a simple template for equity contributions, equity investments. Read it, make sure your legal advisor vets it, and make sure your contract is ironclad. I like the fact that a lot of startups in Nigeria are registering international facets of their business, and a lot of times it's the international part of the business that issues the shares or issues the equity. Again, because sometimes our regulatory environment in Nigeria can be uncertain. So a lot of startups in Nigeria are incorporating abroad, particularly in the US, and it's the US that issues the equity investment. Well, the downside may or may not be a downside is the fact that ideally the lawyer that should be reviewing an agreement that was drafted with a US company should actually be a US lawyer and not a Nigerian lawyer. So again, depending on your level for risk and your appetite, please just make sure your contracts are ironclad. And then have an exit plan. Are you planning to be there until after the Series A and investment of the Series B round? Determine when you plan to exit. Do you want to be there forever until they have an IPO? Because at every point, at every series point of an investment, your investment sometimes can get devalued. So a lot of times in your contract, you may just have a pro rata clause that states that at any point where a new investor is coming in and the valuation of the entire business becomes higher, that you're allowed to purchase new shares such that the overall value of your investment remains the same. So if at pre-seed stage you have 5% of a business, you can then include a pro rata clause that says that by the time the company is doing a Series A round or a Series B round, and maybe the value of your 5% may become diluted, you're allowed to purchase more shares. You have the right of first refusal to purchase more shares so that overall you can still maintain 5% of that company if you want. Or you can decide to have less shares but at higher valuation. So the overall value of your investment remains the same at every round, even though the number of shares in numerical terms may reduce. So think about that as you look at the contract and as you have an exit plan in mind. And then for bridge funding, so bridge funding is not venture funding because you're not getting shares in the company. You're simply, it's really like debt finance. A company comes to you to say, I have a project I want to finance. Can you provide some funding for this? Does a simple contract agreement, and you can even insist on a performance bond. So if, for example, a company wants to build a new manufacturing plant and says, just finance this project alone, I would give you a particular return on investment, and you can put in place a performance bond. So if there are overruns, whether cost overruns or time overruns, there's a penalty, for that, so that the value of your investment is not at risk. Okay. Now, going on, please don't invest in ideas alone. Invest in viable businesses and businessmen. Is there a path to profit? What have these people done before? Don't just, the idea might be sound, but execution matters. So you're not just investing in the soundness of the idea, you're investing in the marketing plan, you're investing in the client acquisition plan, you're investing in the drive, the energy, and the follow through of the entrepreneurs. So those are all the things that you look at when you're considering a venture funding investment. And then rule of thumb, only invest money you can afford to lose in venture funding. Remember I said earlier, it's a 50-50 thing, depending on management. You're not there day to day. You don't see their books day to day. So they're going to take decisions that you're not aware of. Worst case scenario, you hear about it during the board meeting. So there's always a 50-50 chance you can lose your money. So for venture funding, it's high risk. Only invest money that you can afford to risk. The business may also not do well. So it may not be due to the fault of the entrepreneurs. It could just be one policy change or one competitor that comes out of left field. So anything can happen with venture funding because you're not the one managing it day to day. There are different platforms that you can use. So as a retail investor, if you want to find deals, you want to be notified of deals, and you want to be able to seamlessly invest in venture funding deals, there are different platforms: vc4a.com, Future Africa Collective, and then the one my company runs, Volition Growth. At the end of this course, you have a chance to signify your interest in joining my cooperative and my private equity company, Volition. So please just fill that form and you get a referral code to join. And then join online, relevant online groups. There are a lot of online fora that talk about investment. One of them is Money Africa. There are different Telegram groups, depending on, which investment platform you join. Typically, they would have a Telegram group as well. You hear a lot about deals, you hear a lot about opportunities, but always do your due diligence. Don't follow the crowd. Get the information from the groups, but then do your due diligence before you put your money in it. You can attend hackathons. There are different companies like CC Hub in Yaba that do pitch competitions, hackathons, where you can see some of the most brilliant seed stage companies, and you can approach them directly, for equity if you want to invest in them. So there are different ways you can hear about interesting opportunities or interesting businesses. And that's it. Thank you.